Imagine this. You're paying $1,000 for your house every month, and suddenly it jumps to $1,700. You can't pay it. The bank takes your home. Now imagine this happening to millions of people at the same time. This isn't a movie. This is what happened during the 2008 financial crisis. And the scariest part? The people who caused it thought everything was safe. In this video, I'll walk you through everything. The role the government played, how risky investments were packaged as safe, and why people bought into it. We'll break down how rating agencies fooled investors, and talk about AIG, one of the biggest names at the center of it all. From subprime loans to CDOs to the collapse of Lehman Brothers. We'll also cover how the entire banking system froze, and how governments rushed in, spending massive amounts of money to stop a total collapse. So you can clearly understand how it all unfolded. A crisis that wiped out millions of jobs and changed people's lives forever. Part 1. The calm before the crash. In early 2000s, people in the US had one belief. That is, if you buy a house, you'll be richer in the future, and the price of the house would never ever come down. And this belief didn't come from nowhere. They had seen decades of housing price rises, and everyone knew someone who made money in real estate. Not only people, big companies also had this solid belief that house prices would never come down. At that time, if you walked into an investment bank and told them house prices were going to crash, they would probably laugh at you. So everyone at that time saw housing as the most reliable investment they could make. These things were happening after the dot-com bubble. People loved to spend their weekends in malls. They loved to watch TV series like The Wire, Sopranos. Blockbuster was at its absolute peak at the time. Even the movies we still watch today, like Gladiator, Batman Begins, The Notebook, came out in this era. It's been an absolute golden era for movies. People had great hope about the future, and they didn't want to worry about the future. They had great optimism. People spent their money really well at this time. They loved getting home equity loans from the banks, and they loved spending their money on upgrading cars, buying new gadgets. This belief didn't just create confidence, it actually created great complacency among people. Part 2. Everyone was in party mode. At this time, companies like New Century, Countrywide, and other mortgage-related firms were aggressively issuing home loans to buyers. Home loans were very easily to get at that time. If you had no income, no job, no assets, you would still get a loan at this time. This caused so many people to enter into the housing market, which led to more and more people buying houses after seeing others do the same. So the loop started feeding itself, which pushed housing prices continuously. The government also had low interest rates at that time. Because of that, banks were able to borrow money easily, which led to people being able to get home loans easily. You may ask why banks were providing easy loans to low-income people. What would happen if the person failed to pay that mortgage? To answer your question, banks had a simple logic at that time. If a person failed to pay the mortgage, they would sell the house and take their money back because they thought housing would be always high value in the future. Their logic was simple, right? So government, banking, everything was on easy mode when it came to housing. Everyone was in party mode. They were enjoying their investments going up, but they had no idea what was going on behind the scenes. Part 3. The mortgage trap. The companies like New Century, Countrywide, most of these mortgage companies were not only giving good loans, but they were also giving bad loans to low-income people. They called it subprime loans. What do I mean by that? I'll first explain that. Let's say you are making $4,000 per month, and you took a loan from these companies. Your mortgage was $1,000 per month, and the loan is spread over 15 years. You feel like, yeah, that's okay, I can manage that. But 2 years later, your mortgage payment goes from $1,000 to $1,500 per month. How would you feel? Shit, right? This type of loan is called ARM loans. If these loans are given to rich people, they can manage it. If the loans are given to people who manage finances well, they can manage it. But these loans were given to people who can't pay the mortgage easily. So the banks label them as subprime mortgage payers. These people have low credit scores, and the people who pay well and are disciplined are labeled as prime mortgage payers. In the early 2000s, mortgage companies were aggressively pushing subprime loans to people. Not only that, there were other complex things also running behind the scenes. Part 4. The Magic Box That Fooled Investors, CDOs Explained. Large investment banks like Lehman Brothers and government-backed institutions like Fannie Mae and Freddie Mac bought thousands and thousands of mortgage contracts from these companies. Then, they turned them into investment products. They put thousands of mortgage contracts into a box, and they named it CDOs. And they sold these CDOs in the US and all around the world, countries like Europe, Japan, and more. The CDOs are just mortgage bonds inside it. If investors buy these bonds, they receive income from the mortgage payers. That's it. So the CDO is an asset to investors and a liability to mortgage payers. The CDOs sound like a bad asset to hold, right? Because they're backed by subprime mortgage payers. Yeah, that's true. This is the main reason for the 2008 financial crisis. Investors bought CDOs backed by subprime mortgages, and the system collapsed. I can end the video right here by simply saying that, but the system is more complex than you think. If you want to fully grasp what happened in 2008, you need to understand even more. And that's exactly what I'm going to cover in the upcoming sections, so you see the full picture of what happened in 2008, not just surface level. Part 5. Why investors around the world bought these risky CDOs. There are several reasons why investors bought these CDOs. First, you need to understand the rating system. The CDO box is divided into 3 layers. It's called tranches. The first layer is the AAA slice, which is considered a safe investment in the bond market. But the interest payments are low and the risk is also low. They are the ones who get paid first in this system, when the mortgage money flow comes in. And if anything goes wrong, they are the last ones to get affected. So corporate, pension funds, banks buy these slices. They are not looking for higher returns. They just want liquidity. If we move to BBB, this layer's interest payments are medium, and the risk is also medium. They get paid second in this model. Investors who want medium risk invest here, like hedge funds, etc. If we move to the third layer, it's equity, investors who invest in these types of bonds. The rewards are high, and the risk is also high. They get paid last. If anything goes wrong, they are the ones who lose money first. If there is any big leftover money at the end, they would get it last. Usually big investors, smart investors, invest here, like hedge funds, private equity, high-yield chasers, etc. Now you understand the CDO box rating structure, and usually who invest in them. So this kind of rating structure gives investors confidence. People who want to invest in safe assets and risky assets, they see this structure and think AAA is super safe, and the AAA rating at that time was usually given to safe investments like government bonds and things like that, which made AAA-rated subprime bonds sound safe at the time. Second, everyone thought mortgage payment defaults wouldn't happen all at once. They thought maybe some buyers wouldn't pay mortgages, but that wouldn't affect the system. It sounds logical, though. And third, the CDO boxes were not just packed with subprime mortgage contracts, they were also packed with some good prime loans, like car loans, student loans, but the majority was still subprime loans. At that time, this structure gave a fake illusion to investors. All of this made it sound very, very safe to big investors in the US and all around the world. They didn't think twice. They bought these investments, and that's how big smart investors fell for this trap. Part 6. How rating agencies fooled the investors. Rating agencies like Moody's, S&P, and Fitch received money from big investment banks, and they gave good AAA ratings to bad subprime CDO bonds. Usually, rating agencies give AAA ratings to good and stable investments like government bonds and super safe assets. But here, they gave good ratings to bad mortgage contracts. Most of those CDOs were packed with subprime loans. That's the problem what happened in the early 2000s. Because of this, most investors around the world thought it was a good bond investment. That's how rating agencies misled investors at the time. Banks and financial institutions were trading these CDOs with each other with no problem. They thought it was a safe asset.
If we don't give them the ratings, they'll go to Moody's, right down the block. If we don't work with them, they will go to our competitors.
Part 7. The party is officially over. And then 2007 came, the party is officially over. We talked about ARMs earlier, right? So that started hitting people around 2006 to 2007. People's mortgage payments started jumping around 40% to 70% per month. Imagine you're paying $1,000 as a mortgage payment per month, and suddenly your mortgage jumps to $1,700 per month. How would you feel? That's exactly what happened around that time. Millions of people started struggling financially during this period, so they stopped paying their mortgages. Then the defaults started increasing, and foreclosures started rising. And housing prices also stopped rising. The bubble started popping everywhere.
NASDAQ plunged about 52. More and more Americans are having trouble making their mortgage payment. Meanwhile, more troubles for subprime lender New Century, which says it's run out of money.
On April 2nd, 2007, New Century, which was a leading mortgage provider in the America, filed bankruptcy. In August 2007, a major bank in Europe, BNP, said, "We are not able to sell $2.2 billion worth of subprime mortgage bonds." They said liquidity evaporated. Translation, nobody was willing to buy those bonds. And the central bank in Europe started injecting 95 billion euros into the system. That shocked the world, and everyone started panicking. After that, banks and money markets stopped lending to each other, which froze the system. First, I'll explain how the banking and financial system works. Then you'll clearly understand what I'm talking about. Then we'll jump back to the story. This is a core part of my video, so stay focused. Banking freeze explained. At the time before the crash, everything in the banking and financial system was running smoothly. But they had no idea they were all holding time bombs. Banks usually need money regularly to run their system. Money equals to oxygen for them. Usually they borrow from each other and lend to each other. This happens day to day. Banks usually use collateral like government treasury bonds or corporate bonds to borrow from each other. Those are like safe assets. But in 2008, the banking and financial system used subprime mortgage-backed CDO bonds as collateral. That was the biggest problem. I'll give a small analogy so you'll understand it even better. Imagine a community where everybody uses gold as collateral to borrow money from each other. Suddenly, everybody realizes no one is holding real gold. Now the people who gave loans against gold are stuck because it's fake collateral, right? They would lose so much money. And also imagine the loan givers in the community borrowed a lot of money to acquire this fake gold and then gave loans to people. Now their money is stuck in fake gold plus leverage. That's even worse, right? It's not even their money. This is exactly what happened in 2008. Banks and financial institutions borrowed so much money from each other. If they had $1 billion in real asset value, they borrowed $20 to $30 billion to buy valueless assets. This is called leverage. So when they were doing transactions back and forth, everyone started realizing that the system was holding bad collateral that wasn't worth anything. So banks and financial institutions all got stuck in these subprime CDO assets. When subprime mortgage borrowers stopped paying, the collateral lost its value. It became fake gold. The banks and financial institutions holding massive subprime CDO collateral with leverage became the losers at that time. And because everyone had bad collateral on their balance sheets, trust in the system was broken. So they stopped borrowing from each other. The money flow between banks started freezing. Banks and other financial institutions had no cash to run their operations. The system got completely stuck. And this is very, very serious. Because banks and financial institutions roll over money very fast with each other day to day. All the time they borrow from each other and lend to each other. If that borrowing stops, they die. It's like a friend who takes a $10,000 loan to pay off old one, then immediately borrows again from someone else. He's constantly rolling over debt just to survive. That's exactly what banks and financial institutions were doing in 2008 using subprime CDOs as collateral, very quickly in parallel. When everyone started realizing CDOs had no value, the system froze. Money flow stopped. That's why during this stuck period, the government injected money into banks to reboot the financial system. It was not to save banks, it was to save the economy. Many people were angry about why the government gave so much money to banks. This is why. Saving banks is extremely important. If banks were not saved, a second-order effect would happen. If banks had no money, businesses couldn't take loans. That's why GM faced massive problems in 2008. Big businesses are heavily dependent on bank loans. They don't run operations using only their own money, like paying employees or investing. They use banks' loans as well. That's why when the banking system failed, mass layoffs happened across the country in 2008, because every business lost access to credit. I hope now you understand how banks and the financial system work. In March 2008, Bear Stearns collapsed, an investment bank in the U.S. They had a lot of bad CDOs on their balance sheet. By mid-2008, the U.S. government took over Fannie Mae and Freddie Mac. Both were huge players in the housing market. In September 2008, Lehman Brothers collapsed, one of the biggest investment banks at the time. They had a lot of bad CDOs on their balance sheet as well. Plus, they were leveraged 30 times. After Lehman Brothers collapsed, America went into full crisis mode. Because Lehman Brothers was a huge investment firm with 100+ years of legacy, everyone thought it was too big to fail. Then the death spiral started. Banks started losing money because of bad CDOs. They didn't have enough money to lend to businesses. Businesses started cutting employees. People started losing their jobs. They couldn't pay their mortgages, which led to more foreclosures. This kind of deadly spiral started accelerating across the country. Part 8. Government Rescue. And then the U.S. government started stepping in. They injected money into the financial system. They gave a lot of money to banks. If we follow the money, we can clearly see which major banks were holding a lot of bad CDO assets during the 2008 crisis. Because then, why would the government give so much money to these banks, right? Citibank, Bank of America, JP Morgan Chase, all of them got money from the government. They had a lot of CDOs on their balance sheets. Plus, they were highly leveraged, just like Lehman Brothers. Not like 30 times, maybe around 20. And also, I want to talk about AIG and what they did, because AIG was one of the single largest rescues of the entire crisis. The government spent $180+ billion on this. Okay, what did they do? They insured these subprime CDO bonds for large banks and financial institutions in the US and around the world at the time. I'll give you an analogy, you'll understand it better. Imagine you are saying to 1,000 car owners, hey, if your car fails, I'll give you the full money. Just pay me a small yearly fee of $2,000 per year. They are happy, and you are very happy thinking that all cars won't fail at the same time. You are collecting yearly money from car owners and enjoying your life. But one day, out of nowhere, all 1,000 cars start failing rapidly. How would you feel? Can you pay what you promised? That's exactly the position AIG was in during 2008. All banks and financial institutions' bonds were failing rapidly. They had no money to pay everyone. That's why the government had to step in and save AIG. If the government didn't save AIG, then banks would have failed. Part 9. How it impacted people's lives overall. Over 8.7 million people lost their jobs in the U.S. The construction industry took the first hit. Carpenters, electricians, plumbers, architects, real estate agents, all lost jobs. The manufacturing industry took a hit because at the time people stopped buying cars and appliances, so companies had to fire a lot of employees. Plus, they couldn't get loans because the system froze. The financial industry took a hit. People working in Wall Street firms and banks lost their jobs. The auto industry took a hit. People stopped paying car loans, people stopped buying cars, and auto companies couldn't get loans. One of the toughest times was for Elon Musk. SpaceX's third rocket failed. And, to make things even worse, Tesla was on the verge of failure during this time. Because of the bank freeze, he wasn't able to take loans, and he even struggled to provide payroll. The government rescued GM, which is the biggest car manufacturer in the U.S. Retail and small businesses faced heavy losses. People stopped eating out and stopped going shopping. That's what happened in 2008 overall. One of the toughest times for people. It completely changed their lives. What were you doing at that time? Do you remember anything? Let me know in the comments. And I would like to close this video with one thing. There's one important lesson we can learn from 2008. Stability is not guaranteed. Even if we have a good job that pays really well, we can't guarantee it's permanent, no matter where you work, what you do, or who you are. That's why having an emergency fund and having multiple sources of income is necessary. 2008 clearly showed how both of these are very important for our lives. I'll end this video with that statement, and thanks for watching.